What if apply the legendary Benjamin Graham's investment principles to analyze the stock performance of Tesla? Ready? Let's start. Adequate size of enterprise. Tesla, with a market cap of $598.45 billion and an enterprise value of $574.59 billion, certainly qualifies as a large-cap company, which Graham preferred due to their stability and ability to weather economic downturns. Sufficient financial condition. Tesla's current ratio of 1.73 suggests that the company has a healthy short-term financial strength. Graham typically looked for a current ratio over 1.5 to ensure sufficient liquidity. Tesla's debt-to-equity ratio of 0.08 is exceptionally low, indicating that the company is not highly leveraged, which aligns well with Graham's criteria for financial stability. Earnings stability. Tesla has shown a remarkable ability to grow its revenue and earnings over the years, demonstrating the earnings stability that Graham valued. However, there has been a decrease in EPS growth, which Graham might consider a potential red flag. Dividend record. Tesla does not pay a dividend, which would be a negative point from Graham's perspective, as he valued companies that provided shareholders with regular dividend income. Earnings growth. Tesla's earnings have grown substantially. While Graham sought a minimum increase of 1/3 in per-share earnings over a 10-year period, Tesla has exceeded this requirement within a shorter time frame. Moderate price-to-earnings ratio. The price-to-earnings ratio is a valuation metric that shows how expensive a stock is relative to earnings. Graham preferred a P/E ratio of 15 or lower for defensive investments. Tesla's trailing P/E ratio of 43.70 and forward P/E of 49.68 are high and would likely be considered overvalued by Graham's standards. Moderate price-to-book ratio. The price-to-book PB ratio measures a stock's price relative to book value. Book value is also called shareholders' equity. Graham favored a PB ratio of no more than 1.5. Tesla's PB ratio of 9.55 would be seen as quite high, signaling an overvaluation by Graham's conservative valuation methods. Safety margin. The price-to-free cash flow ratio is similar to the PE ratio, except it uses free cash flow instead of accounting earnings. Known for his margin of safety principle, Graham would likely find Tesla's high price-to-free cash flow ratio of 137.35 and Tesla's the enterprise value to free cash flow ratio of 131.88 concerning, suggesting a lower margin of safety for investment. Conservative valuation. Tesla's PEG ratio of 2.09 exceeds the value of 1, indicating that the stock may be overvalued relative to its earnings growth expectations. In summary, Tesla exhibits the growth and financial stability that would attract a modern investor, but its high valuation metrics would make it less attractive from a traditional Benjamin Graham value investing perspective. Graham's conservative approach would likely conclude that Tesla stock does not offer a sufficient margin of safety at its current valuation, despite the company's impressive growth and strong balance sheet. Now let's look what other analysts think about Tesla stock. The 12-month price forecasts for Tesla stock have an average target of 226.52, with a low estimate of 85 and a high estimate of 380. The average analyst rating for this stock is hold. This means that analysts believe this stock is likely to perform similarly to the overall market.